What's going on, everybody? Welcome to the channel. And in this one, we're going to be going over an analysis on an easy way to skyrocket your portfolio and add yourself with a ton of extra income as long as your portfolio has the capital to do this. Now, we will go over how much capital you really probably need in order to do this strategy and how you can make easy passive income in the market. And I know of some people, I literally know people who use this strategy for their full-time income. It's incredible the power of this strategy. Now, this strategy, I'll just give you guys a little spoiler, is selling cash secured puts and selling covered calls. We'll go over what these are and exactly how to do that. And before I go any further in the video, I'll ask if you enjoy dividend stocks and dividend investing. You make sure to give it a thumbs up and you subscribe to this channel for videos coming out Monday, Wednesday, Friday, all about dividend stocks and dividend investing. But enough of the talk, let's get into the video. So you're looking at my portfolio on M1 Finance. If you want to use M1 Finance, use a link in the description or the pinned comment where it says M1 Finance. You sign up with that link and deposit $100 into an account that you create. You'll get a free $50, which is insane stuff, 50. That's a lot of money. You could take that money out, buy Chick-fil-A with it, or you could do whatever and then reinvest that back into the market. Now, if you want to do this strategy, you will not be able to do this strategy on M1 Finance. Today, we'll be looking at how to do this on Robinhood. You just need to be able to do it on a brokerage that offers options. So this is not buying options, this is selling options. Just like whenever somebody buys a stock and there's a seller for that stock. Just like when somebody buys an option, there needs to be a seller for that option. So let's go ahead and talk about what even a cash secured put is and what a covered call is. So the way this strategy works is you first off sell cash secured puts and then you sell covered calls. So let's talk about this. You sell a cash secured put, and that is something that obligates you to buy shares of stock or an ETF at a specific price on a specific date, and you get paid to make this trade. So let's just go ahead and use this ticker TNA and give you a visual before we go into definitions actually. So we have ticker TNA, which is a 3x leveraged ETF, meaning that this fund uses leverage like debt to get bigger returns on this ETF. However, with bigger returns and leverage comes bigger losses. So these are very volatile. And the way to make money in investments that are super flat like this is to trade the wheel strategy. Now let's go ahead and talk about how this process works. So what you do is you hit on the sell button because you're going to be selling an option. And then you're going to be selling a put. So selling a put, you'll see all these different metrics. Let's go ahead and zoom out because I feel like this is a little too zoomed in. You have the strike price. Really what you need to know is the strike price and the actual price, and then the expiration date. So let's go ahead and use the January 14th expiration date as I'm recording this on Sunday, January 9th of 2022. So let's go ahead and say you really want to buy in on TNA, but you don't want to pay any more than $75 a share because you don't think it's worth any more than $75 per share to buy in at least. So what you do is you enter a short put, and it really doesn't matter. It's the same thing as a cash secured put, and you click on this. What this means is you are willing to buy, because options work in 100, you're willing to buy 100 shares of TNA at $75 per share. And the reason that you have this January 14th is because if by January 14th, TNA, the ETF, the stock, is below $75 per share, you are obligated to pay $75 per share no matter what. Now, let's say that TNA fell all the way down to like $50 a share. Because you're in this trade, you will still have to pay $75 per share. So in order for me to enter this trade, I'm going to have to put in 75 times $100, which how much money is that going to be? That's going to be $7,500. And here's how this entirely works. You put up $7,500, you deposit it into Robinhood, and you enter this trade. Now, what do you get from entering this trade? You get a credit of $220. So this $220 will be deposited directly into your Robinhood buying power, which you could take out. Robinhood's not going to take that money. You could take it out and put in your bank account, and Robinhood will never ask for that money again. So this is all the outcomes that could happen by entering this trade to get this free $220. One, TNA stays above $75 per share and nothing happens. By January 14th, when the market closes, your $7,500 will be deposited right back into your buying power. And then the next week, you can make this exact same trade again. Option number two is the stock price falls below $75 per share. Now, this is whenever you would actually get what is known as exercised, meaning that you will have to buy 100 shares of TNA at $75 per share. So that $7,500 that you put into your Robinhood account to make this trade will be used to buy 100 shares of TNA. So now you would own 100 shares of TNA, but you would also have $220 worth of credit and buying power into your account. Now, what really spices up this trade and this option strategy is whenever you can sell covered calls. Now, we'll go into that in a little bit later in the video, but the main thing is that this is a very profitable strategy. Now, let's go ahead and get into a deeper analysis on what a covered call is. You pretty much are just obliging yourself that you will pay for those shares. And in order to take on that risk that you will pay for those shares at this price, if the stock price is lower, you're going to get paid that credit. And that's what you're taking on the risk for, is that you'll pay for those shares and you're okay with paying that share price. And the lower you go, the lower that you're willing to pay, the less money and credit you're going to make. Now, if you're willing to be a little bit of a risky person and paying closer to the current share price, you'll get paid more in credit. My suggestion is you kind of think of common sense and then you look at how is the stock kind of performing historically. So if we go to price history, you just see how often, like, what does the stock price move? Like this week, it moved down $8. So you got to be ready. If it's going to go down $8, it's a very high possibility. So you want to go back into the option and you want to see if I went to $77 and minus $8 from that, that'd be about $69 per share. How much money would I get from entering that? I'd get about $81 in credit. It says 81 cents, but then you multiply it by 100 because options work in 100. So let's take a hypothetical world and say you got exercised for TNA and you had to pay $7,500, but now your average share price is $74. So now you're technically still $120 in profit because you paid $7,500, but you have an average share price of $7,400. So pretty much that's a negative $100. But then you got $220 for ending that trade. So you're $120 in profit. Now what you do is you sell a covered call. And that is whenever you're willing to sell your shares at that strike price. And in order that you're willing to sell your shares for that price, you're going to get paid a premium for that. And premium is just cash. So the numbers would be a lot different because after this trade would have happened, the share price would be different. So meaning that these prices would be different. But take, for example, you paid $74 per share and then you just went back up to $75 per share. You would be making another $100 in profit. Or even if you did 76, you'd maybe be making $200 in profit because for each share that you own, which is 100 shares that you got to sell, you take that $2 difference between 76 and 74 and you multiply 100 by 100 because 100 shares and a $2 profit on each is $200 in profit. And then you would also be getting paid to enter this trade, which is going to skyrocket your stock portfolio because you're getting paid to enter these trades. You're getting paid to get these profits on these different stocks. Now, the only thing that is very risky is that what if the stock just continues to fall? Well, then, relatively speaking, once you get exercised on your cash secured put and you own those 100 shares, you just keep selling covered calls and you keep collecting that income until hopefully that the day comes when you will own that, when you will sell your shares and hopefully you sell for a profit. Because what you don't want to do is keep making these trades and you just buy in at $74 per share and the stock price keeps plummeting and plummeting and plummeting. And as you keep entering these trades, you don't want to end up selling for $50 a share unless you do the math. And I would recommend, if you do this, that you keep a spreadsheet on how much money you're making in credit to make sure if you're being profitable or not. Unless it's profitable for you to sell at $50 per share and you don't see any potential in TNA recovering. But what you really want to do is, the reason I chose the 3x leverage ETF is because that these are more volatile. It's going to pay higher premiums, meaning you will get paid more money in order to enter these trades because they are slightly riskier. Now, you can do these on regular stocks. You could go do this on Starbucks, Microsoft, Apple, Home Depot, Realty Income, whatever it might be. You can definitely do that. All that matters is that you have 100 shares that you're willing to sell right now in order to sell a covered call, or that you have enough money to pay for 100 shares at the strike price that you're willing to pay at to put into your account on that stock. And that's how much money you really need. So you just take the current share price, multiply it by 100, and that's how much money you're going to need in order to enter this call. And this can definitely be a completely life changer and skyrocket your portfolio, help you add more income. Now imagine if you were making just one of these trades every week and it was going the way you want it to go. You could be making an extra roughly $300 per week. Imagine what you could do with $300 per week. Imagine if you were making $300 per week in dividend income. You might be making $300 a week, but what if you're not? You could still be skyrocketing your portfolio right now from just doing an extra 5 minutes of work every single week. Now, my word of advice is do this on stocks and companies that you really believe in and that you're okay with owning, and also that have upward momentum and are very green over the long term, because you want to be doing this on uptrending stocks. And that is how you trade the wheel strategy. You first off sell by selling a cash secured put, and then once you get exercise, you go off and you sell covered calls, and you keep collecting these credits and you let your portfolio skyrocket. But everybody, that is what I have for you in this video. So if you did enjoy it, make sure to subscribe to this channel and you turn on post notifications so you don't miss out on any future videos. Thank you so much for making it to the end of this video. I actually have another YouTube channel called Investing Alpha. It still has no videos out, but I'm making an entire company right now. We're going to be doing a lot of stock market education, having courses, and you don't have to enroll in them. They will be paid courses, but if you want to check them out, I will be sure to give you guys that link when the courses are published. But thank you so much for all the support you guys have been giving this channel, and I will see you at the next video.